All right. Well, good afternoon, everyone. It's Joe Pochodyniak here with you at McNichol and Associates Asset Management. So good to see you all. And today we're going to be talking about logistics real estate, and we brought in two of our partners from Bridge Investment Group, Jay Kornforth and Brian Gagne, who are experts in this area. I've always been fascinated by logistics, industrial real estate and that sort of thing. I always think that in life, if you don't have good logistics, you just sort of have a series of basic ideas. So Jay and Brian, welcome. And for those of our investors who do not know Bridge Investment Group, we're into the LPs right now and growing that relationship. It's been going great. And so Jay and Brian, we appreciate you being here. For those of our clients who may not know you, why don't you go ahead and take maybe 60 seconds to introduce yourselves and kind of what the idea is behind Bridge Logistics Properties.
Thank you, Joe, and thanks for having us. Look forward to kind of sharing our insights and our thoughts here over the next hour together. So I guess, my background is, and as you know, I grew up in Canada, and when Brian and I left Brookfield, so we worked at Brookfield, and I was their managing partner, global head of logistics. Now I was based in New York City, not in Toronto. But we were at Brookfield for about a decade before Brian and I left in mid-May, June of 2021, to start Bridge Logistics Properties. So coming back to Canada and frankly having a Canadian investor in our fund is very gratifying, and thank you very much for your faith in us.
Yeah, and Brian, maybe with the hockey game going on tonight, give us a little insight into your background and all of the shots you would have taken as a hockey player, but also in business.
Yeah, the Boston-born hockey player. I'm a goalie, so played up through college. But yeah, my entire career I have been in the logistics space, specifically infill, value add development. I started my career with KTR Capital, which was the premier infill investment shop in the U.S. focused on logistics up until sort of 2015, where we sold that company to Prologis. Jay and I did not meet in that transaction, but that's really when our sort of business partnership began. He recruited me to come over to Brookfield, and we've been together since. If you Jay and I, like, we come from similar schools where we believe it's best to invest in marketplaces that have population density, have really high constraints on new supply or the building of new warehouse product. It's hard to build product there. And, we both come from backgrounds where we're not just deployers of capital. We come from construction, entitlement, development backgrounds where we improve assets in order to improve NOI. So that's our schools, and that's who we are.
Excellent, excellent. So yeah, that's a really great intro. And I don't know if you guys want to put something up on the screen or if you just want to have a dialogue. I have quite a couple of questions, so whatever's your pleasure.
It's up to you. I think let's just go with some questions now.
Sure. Well, you know what? Let's start off at the top because sometimes we have these discussions, and we've been adding to industrial over the years here. It's been a great replacement for sort of a reliance on traditional office and retail product. But just sort of at a general level, let's start with first principles. What is industrial and logistics real estate? Because sometimes you say the word industrial real estate, and they think maybe we're investing in an oil refinery or something like that. So just sort
Mhm.
of talk about that.
Yeah. Well, I guess maybe I'll start. I mean, I think we've become a lot more familiar with what industrial or logistics is, really beginning with Amazon, right? And when we started buying product from Amazon on our iPhones around 2013 or 14, one, that was a key inflection point in terms of demand for industrial or logistics real estate. But I think the general public became quite familiar with these warehouses or fulfillment centers that were basically delivering product to people's homes. And so, in essence, the way I view industrial real estate is we're kind of a toll collector. Like anything that's in the supply chain, and we'll start at a factory somewhere in the world. And by the time it gets to the end consumer, that finished product is going to sit in a warehouse, right? It could be our warehouse, it could be other companies' warehouses before it gets to the end consumer. But then the other piece of it is part of the supply chain. So as you think about manufacturing in Canada or the US, a lot of parts are sitting in warehouses before they get to the factory floor for assembly. We really are a toll collector in terms of the global economy, where so much is flowing through these warehouses before it gets to the production line or before it gets to the end consumer. And with it is a nature of different industrial properties, meaning you could have a 1 million square foot fulfillment center. You could have in the GTA, right, in the Etobicoke or Mississauga, you could have a 50,000 or 100,000 square foot warehouse that's delivering product to the general regional market. So it really runs the gamut, but it's all part of this integrated supply chain, and it's global, right? It is absolutely global in nature, and we're just the end touch point in many ways before it gets to the consumer.
And the one thing I'd add to that, Joe, just is what's interesting in our space or the movement in our space that's created this swell in rents and occupancy is that the way people are consuming today, meaning, online via Amazon, it's really fascinating their behavior where today, thanks to Amazon's early efforts, 70% of people in the US expect same day shipping. And when they can't get that, almost 40% of those people are aborting purchases. So all of a sudden, retailers are now threatened. There's this threat of lost sales if they can't supply people in that fashion. And what's really interesting is the old supply chain in the US, it was okay to have a warehouse 400 miles away, 500 miles away from a major population center, and that good got to a store in 2 to 3 days. That was fine. Now, because of the same day shipping demand or this sort of now effect, the you need to move that warehouse from 600 miles away to 20 miles away from where people live. So these really healthy infill logistics markets that were always well occupied now have this added pressure and demand that are really sort of creating some of the value gains that people have heard about.
And Joe, I would add, Brian and I both have this Boston connection. Brian was born in Boston, and I was based in Boston while I was at A&B, which became Prologis. So I was there for many years. And if you look at Boston as an investment market, and while at Brookfield, Brian and I pivoted to that market probably about 7 years ago, just as Amazon was entering that market. Well, what's fascinating, we have it in our market deck that we share with our investors. The Amazon footprint has gone from 250,000 square feet in Boston to 14 million square feet over the last 6 or 7 years. That's all around touch points, getting to the consumer. This is what Amazon is doing in many of these infill markets around the country. Boston's just a fantastic example of getting to a 15 million square foot footprint. Talk about
Right.
added demand for warehouse product. And by the way, 6, 7 years ago, cap rates in Boston were 7%, and in New Jersey, they were 4. Now
Yeah.
they're almost right on top of each other, right? So Boston's become a much more institutional market. And, Brian and I, not to toot our own horn, but we kind of saw that wave coming. And there was a real disconnect in the capital markets where we really capitalized, and we built a fantastic portfolio for Brookfield and now BLP. We have 3 assets in Boston in our funds.
Yeah, that's great. That's great. And Brian, don't worry, we're not judging because the game is tonight in Boston or that you're from Boston. But let's maybe so that's an excellent intro. Let's maybe kind of transition into this whole concept of maybe 25 and 26. Seeing a return of some of those pre-pandemic drivers. So I have one sort of quick question, which is, do you see industrial lease rates in 25 and 26 maybe getting back to or close to those peak levels that we saw in 21? And then after that, I want to talk a little bit about third-party logistics providers, because I think this is something important for us to discuss for our investors.
Brian, you can answer that.
Yeah, I can lead out of it. I mean, the U.S. has been in what we would call a transportation recession over the last, call it 2 years. And what is that? The amount of goods that are flowing through the system are a lot less. The truckloads that are in the marketplace are less. And why is that? I mean, it's a cyclical reset. I think with the interest rate reversion, we saw a lot of American retailers and companies take a defensive posture, not just in terms of the inventory they had on hand, the purchases they were making, but also the expenditures in building their supply chain. So there's been this slowdown that we've been working through and then almost a reset to the marketplace. But that's no different than the GFC. That's no different than what happened in our space in the tech bust of 2001. We're very accustomed to sort of this bracing, adjustment, softness in rents, sort of a buoying in availability. What happened, the history doesn't repeat itself, but it certainly rhymes, right? So, what happened in the GFC after that little bit of reset, the recovery in every marketplace is 2 to 3 years it took for rents to come back to peak. I will say that in a lot of our marketplaces since the election, we've seen renewed tenant activity, largely because maybe they have a little more comfort in sort of Trump's sort of economic policies. So we feel like there's a bottoming, or we're sounding that bottom of trough, and a recovery shape is coming into form over the next few years. So I don't know what you'd add to that, Jay. But
Yeah, the only thing I'd add is like just for context, again, coming back to the supply chain, rents only make up 6% of supply chain costs. Transportation makes up 50%. And of that 50, half of it is the last mile, right? That fulfillment, which is why Amazon's building all these warehouses next to population centers. So when it comes to pricing power, like it's really a function of supply and demand in the marketplace. We certainly went through this cresting where supply peaked at in the US at 600 million square feet. Historically, we've been averaging about 300 to 350 million of new supply or new starts. And now we're back down to about 150 million square feet. So supply has really, really tailed off. And in combination, we're seeing this cresting in vacancy rates nationally, right? Like market houses are suggesting vacancy rates will peak sometime in this quarter or next at around 6.5 to 7. For historical context, Joe, right? Like in the United States, I know it's different in Toronto, but in the United States, a 7% vacancy rate historically is really, really strong. And you do have landlord pricing power at 7%. So to answer your question, we've certainly seen a drop off in rents because rents certainly doubled over the last, call it 3 years, but rents relative to supply chain costs, are not as important as location. So our job is get in the middle of it, make sure we have the right assets and the right markets. That's going to really drive rents. And so we remain quite constructive and bullish on kind of, rent growth, moving forward.
Yeah. So is it like fair to say then that, net absorption will remain, like I'm talking overall net absorption will remain low to maybe like medium. But are you getting a sense in your work that a lot of this is coming at the expense of older vintage product, so that 50 to 150,000 square foot box was built in the late 80s, no one wants that because there's smarter and prettier buildings just down the road. Is that kind of the dynamic that's in flux here?
It's actually kind of the opposite in the market. So we focus in sort of what we call the coastal gateway markets of the US. So that's LA County, that's Northern New Jersey, New York City, Miami-Dade. And a lot of those are very infill, almost urban markets where it's hard to deliver new product. A lot of the base there is, I would say 85 to 90%, call it Class B. And when you look at LA specifically, a lot of that product was built in the 1960s, 70s, and 80s. But because of its strategic location and proximity to the port and where people live, the wealthy coastal population, that space remains incredibly well occupied. Now, as Jay talked about, the new construction space that was delivered over the course of the last 18 months, that's where there's a lot of availability today because of this bracing that corporate America did, where they kind of evaluated their sort of supply chain footprint and said, I don't need to take down new space today. I have some capacity in some existing buildings. I'm also really curious to see how the American consumer's health is and sort of where this economy goes. So that those newer deliveries have struggled. There's vacancy within it. But I think when corporate America starts to spend again, that'll be the first space to go, to your point, Joe, because it has superior functionality. But yes, the urban markets that we focus in, the older vintage existing inventory, because of its strategic location, have actually held up very strong.
Yeah, good. No, fair point. And I did get the email about the Brooklyn assets. So I'm glad you kind of mapped out those coastal gateway markets versus the other. Let's talk a little bit about this whole third party logistics thing. So let's say I have a company, I'm a retailer or a wholesaler, and let's kind of keep the theme going here. So let's say I make hockey sticks. I think there's
Nike
three.
hockey sticks or CCM?
Yeah, that's right. Yeah, good point. Good point. Yeah,
CCM. Let's go with CCM. We have a
the winning
Canadian.
hockey sticks, Jay. So we'll say the winning ones. But I think a lot of our investors would understand some of the reasons why you'd want to essentially outsource your distribution function. One is obviously a focus on your core business, which is if you're making hockey sticks, maybe just concentrate on that and let somebody else help you distribute the product. Another one is capital preservation, right? So if you're a business owner, obviously your cash flow is your everything. But in terms of import flexibility, what in your minds, like how high does that rank? Because there's things like geopolitical events, weather events, labor events, right? Talk to us a little bit about that from a context of the 3PLs.
Well, I guess like I'd start with 3PLs. To me, it's a tricky proposition for corporations, right? Because supply chain efficiencies can really drive margins. And when you think about kind of reaching the end consumer and understanding them, kind of that digital experience, right? You have the front end experience, and that could be Shopify, by the way, that are helping out a lot of these merchants. But ultimately, at the end of the day, consumer satisfaction is around delivery and getting that product in their hands as quickly as possible, as Brian noted. So I think as companies mature and scale, they tend to want to, rent and control their own supply chain versus relying on 3PLs. And I can tell you from our experience, like 3PLs, they're not necessarily the most sophisticated user, right? Because they're trying to win business. Their contracts are typically 3 years. They operate out of, call it tertiary, kind of C assets. So I think the more sophisticated users as they scale, they really want to control their own operating environment, vis-a-vis meaning controlling their supply chain and being direct with a landlord like BLP in leasing warehouse space. So it runs the gamut, but I would say by and large, corporations tend to want to do it themselves in terms of controlling their space.
Yeah, and the only thing I'd add there, Joe, is Nike has been very transparent with their build out of their own sort of e-commerce direct-to-consumer network. And they say exactly kind of what Jay said is a huge capital outlay. It's a ton of brain damage and effort to build this. But what's the product of that work? They get closer to their customer. There's no sales lost. But then at the same time, when you look at sort of the e-commerce distribution network versus a traditional block, sort of a retail center, the profit is closer to low teens returns or profitability versus mid-single digits. So, if they have the capital, they're trying to do it themselves. Who else is doing this? It's Home Depot, it's Lowe's, so it's the bigger retailers driving that. The 3PLs offer that sort of flexibility and that these smaller retailers have to execute through because they're contracts and they can mitigate risk, grow in areas where they need to grow. They can be very flexible because they just don't have the capital to build it out as appropriate. So
Right. So if you need the help is there. But if you're big, well capitalized, and know what you're doing, it's obviously more economic to do it in house. I think we get that. I'm glad Brian, you talked about returns. So maybe just from a value add versus core perspective, just maybe give us your thoughts on kind of cap rates going forward, and do you see much in the way of cap rate expansion? Because if caps kind of stay where they're at, then you absolutely want to be in a value add strategy. Would I have a fair thing to say?
yeah, I think, well, early in the interest rate sort of reversion or reset, we wanted to get dynamic and forward looking in our underwriting and really be disciplined with this changing environment because we knew that inflation was going to become sticky again. It hadn't been for some time thanks to China and their cheap production. now that the political environment is getting a little sticky and there's different elements at play, we realize it's going to be a different valuation or interest rate backdrop to our deals. We use the forward curve to sort of predict exit cap rates of the 10-year US Treasury. And we've studied all our major markets and understand historically core assets leased at market, high quality, institutional quality, what the risk spread was at that time to the 10-year Treasury. We apply that risk spread to the forward curve, and it's imperfect because the forward curve is always changing, but it's a science that we can utilize in order to truly gauge what is a good value and what is not, and of a truly sort of inflationary or a sticky inflation environment moving forward. When I think about sort of the cap rates today and sort of what we're doing on the value add side, I mean, we're stabilizing deals back to sort of 7% levels. And, what is our exit? It's probably in the fives. When you look at sort of a US Treasury stabilizing in the mid to high fours. And that provides us the risk spread necessary to deliver high teens leverage returns. So that's a little bit of the backdrop and how we look at cap rates. I will say today, though, when you look at where core buyers are pricing deals, it's extremely aggressive relative to the 10-year Treasury. I think there's a lot of capital trying to rotate into our space. And I think there's a lot of buyers that are still underwriting some sort of interest rate sort of compression in the near term, which I'm not sure is actually going to transpire, or rental growth that's just not going to happen in the near term in our markets. So that's been fascinating to watch. So like in LA right now, what is a core deal? It's a 5.25, and that's aggressive. So
Yeah. Okay. That's really good. And just sort of one thing, because you talked about Shopify, which believe it or not, we were one of the seeds for that through an LP here in Toronto. President Trump, I think it's fair to say, is pretty open-minded on the whole digital asset currency, blockchain, all that kind of stuff, to the extent that I believe David Sachs from PayPal is now a very senior member in Washington of the Trump administration, as well as Paul Atkins, who's I don't know if he's been confirmed, but the idea is that he'll be the SEC chair. Does blockchain and cryptocurrencies and all that kind of stuff, have you guys seen a link between increased adoption in that and even more e-commerce growth? Or is it more like what you were saying earlier, where e-commerce growth was like more Amazon, like if you can't get it to your front door in 2 days, you don't want it, type of thing?
I haven't seen anything in blockchain. Have you, Brian?
no, I would say that our consumer behavior hasn't been swung by sort of his support of blockchain, but I would say that their e-commerce sort of the reliance on e-commerce and sort of same day delivery is only growing. As this younger consumer base, begins to have families, like it's amazing. These households are basically supplied same day. So the digitization is pretty amazing, the adoption rates here in the US.
Yeah, and Joe, I guess it's worth noting, like in the US, retail sales, e-commerce as a percentage of total retail sales today is about 17%. So it's well below China at 50% or the United Kingdom at 35%. I don't know what it is in Canada. Do you know what your penetration rate is in e-com?
I know it's above yours, but it's nowhere close to like the Chinese rate at 50 or the UK rate or even most of Europe. So it's a little bit better. I think Canada is more, as you might suspect, and the United States is probably like this too. It's more regional. Everybody in Toronto has to have stuff immediately or they don't want it. And then you get, north of the city and there's maybe a little bit more, I guess, patience and more of a slower pace of life that drives that. But you're right. It's the e-com penetration rate, because I'm on the distribution email for your newsletters. That's a lot. That's a big gap to catch up. Like going from let's just say 20 to 50. That's a huge amount of penetration that you can get into the market.
Well, I think like just for the audience, it's just worth noting that, e-commerce in terms of the demand for it, right? When you look at just the warehouse demand, typically to go to kind of a fulfillment center model or a digital model or an e-commerce model, whatever you want to call it, typically requires 3 times the underlying warehouse space versus a typical brick and mortar supply chain. And it's fascinating. One of the reasons why is a third of what we order typically comes back in returns, right? So you think about that.
Mm,
Product comes back and needs to go back into a warehouse. And the other thing, think about, we're breaking down these massive pallets and they're going into, much smaller, into boxes that take up a lot more cubic volume, right? So you need more warehouse space for that as it's leaving the warehouse because it's the end product. It's a computer in a box takes up a lot more space than a crate in a warehouse. So that actually adds, the statistic, and it's been well verified now over the last 15 years. It's 3x the amount of space, which is really fascinating. So as e-commerce grows, we are correlated to the underlying economy, but e-commerce net adds 3 times the amount of demand for warehouse space that a traditional brick and mortar supply chain does.
right.
And so that's just been a fantastic driver of demand for us over the last decade. And by the way, we've had real rent growth for the first time over the last decade in the history of industrial real estate, right? So we always had rent growth that kept pace with inflation.
Yeah.
Well, now we've got this class leading rent growth, higher than multifamily, certainly higher than retail and office, better than any other sector. And e-commerce is one of those drivers. So, that's why we're very bullish on rent growth, because like we still think we're kind of in the early to mid innings around e-commerce penetration in the United States.
Yeah. Yeah, and it used to be this sort of Blackwater real estate product type because, hey, look at these fancy shiny office towers that got pegged into the ground in the '80s, and now like I often think what your jobs would have looked like 20 years ago. Like, would anybody even take a call with two logistics PMs? And the answer is it's not exciting. Who cares? Now your phones are probably ringing off the hook. I want to talk about and I know we kind of grazed it at the front end. I want to talk about reshoring and manufacturing. I know that's a big sort of idea to say, well, made in the USA or made in Canada. And I know a lot of that happens, but I think the reality is, a lot of our, like I wrote down in here in my notes, Mexico and Ontario. I mean, Mexico still makes a lot of cars for the United States. And so with that sort of Mexican low industrial vacancy rate, are you going to see more and more companies saying again, we need 250,000 square feet on Interstate 29 or 35 going up into Texas, Oklahoma, that type of thing.
Right. It's a loaded question. I mean, like they're probably Joe, like our biggest focus right now is understanding shifting global trade flows because of Trump's now position in the White House 2.0, right? So when you look back over the last whatever decade, what is the actual onshoring that happened in the US? It's very limited. It was high value items, right? Tech, some cars, things of that nature, right? Chips. When you look at nearshoring, that's when it gets really interesting is, and we went back and we studied sort of the origination or source country of imports dating back before Trump, starting in 2015 all the way to today. And when you look at his first term, he threatened a lot of tariffs. His actual implementation was very selective. So when you look at what actually transpired, Mexico, they picked up sort of a mid-single digits improvement in product, but I think, the nearshoring to Mexico was kind of oversold. I think there was a lot of people that were really talking that up. And when you look at China and Asia, you really have to look at them together. Yes, China bled a little bit. Like they were 56% of our imports and then they fell to about 40%. But where did that bleed go? It went into Taiwan, it went into Korea, went into Vietnam, other Pacific Rim, cheaper production companies that use the same trade lanes to the US via the ports of LA Long Beach. So we're always looking how goods are coming into the country to ensure that the way in which we're looking at markets is correct. There's going to be either an increasing demand dynamic or a receding demand dynamic. Mexico's interesting. Like, there's a lot of people playing those border markets and trying to get that flow. that doesn't really fit with our investment thesis, where we think the most durable demand is owning a warehouse next to where people live. So we like the idea of some of that product traveling north, stopping in Dallas because there's so many houses to serve there and businesses to serve, but then traveling elsewhere, kind of compounding sort of warehouse demand in those markets rather than investing in Laredo where no people live and it's really just a handoff market. So
I mean, frankly speaking, as a Canadian and American, this whole thing around tariffs is just nuts to us, right? We do have this NAFTA agreement. We have a very integrated supply chain, particularly in autos. So I don't know. Like it's something that I don't quite understand, other than I can appreciate the situation in Mexico just around migrants passing through Mexico trying to get in the US. I can appreciate that and the fentanyl trade. But net trade between our three countries is critically important because we have been decoupling. We are trying to decouple from China. As Brian noted, a fair amount of that is going into South Asia. But net, our three economies all benefit. So for me, I don't understand. It's lost on me. But it gets my parents quite emotional. They're still living up in Montreal, and Trump, they call him Le Grand Orange. So they're like, right, the big redhead. So anyways.
Well, it's I'm and Jay and Brian, those are fair points, and I'm glad you made them, because sometimes what you see on the front page of CNN or CNBC, you got to kind of say to yourself, what's the source of this? What's the motivation of the writer? So the whole reshoring of manufacturing, again, it's stuff people talk about, but the fact is they're talking about it a lot, and so I appreciate you taking on that question. We're coming up to the 45-minute mark here, so I just want to maybe take a few moments and get you to maybe dive into the fund a little bit. How much do you have in capital commitments? This is a big fund from our perspective here at McNichol, so just sort of share with us the metrics around Fund 2, I think it is.
Yeah, I'll start. And we have Nicole as our portfolio manager. She's on the call too. So Nicole can always correct us if we're wrong. But yeah, to your point, it's $1 billion fund target. We can upsize that, Joe, to $1.25 billion. And today our fundraise is a little over 600 million. But we're really, really pleased with our reception. This has been a challenging environment to raise capital. We've had a reset in valuations, right? Like property values generally are down about 20% in logistics, and land values are down 40%, and rent's been down in quite a few of our markets. So, and fund managers are not returning capital back to pension plans or investors. So you've had all this dynamic at play, but yet we've been really well received. And so we're really appreciative of our investors who have supported us. And we have investors from around the world. We have Asian investors, Middle Eastern investors, Europeans, and of course, North Americans. So really, really thankful for that. We have a lot of hard work, ahead of us. But also I would point out this opportunity, and again, not to sound too much like a marketing thing here, like this is going to be a fantastic vintage. Like we are at a key inflection point in terms of values. Like we're really excited for this vintage, and we're excited to prove to our investors that this is going to be a fantastic vintage.
Yeah, excellent. Well, great. I mean, that was really exciting for me personally, professionally, and I know our investors greatly appreciate certainly the partnership with yourselves, but also the wider Bridge Investment Group. So Jay and Brian and Nicole, I thank you for doing this. We appreciate you being here, and I know our investors place a lot of value and trust in your decisions. So thanks very much. And thank you to Ina Kadekel for organizing this, and Ken Reed for any additional information on all the great stuff we have going on here at McNichol. Check us out at mcnicholasset.com, and have a great rest of your week. And I have to say, sorry, Brian, but go Team Canada for tonight.
Canada.
USA.
Great. Okay. Thank you, guys.
All right,
Yep,
thanks,
take
guys.
care. Yep.
Okay, see ya. Bye.